Hey everyone, and welcome back. Today we're going to do a deep dive into the world of corporate finance.
Ooh, exciting.
It's going to be fun.
Yeah.
So we're looking at some classic finance texts
Yeah.
from Westerfield and Jaffe. These are kind of like the big names in the field.
The bedrock, yeah.
Yeah, exactly. And we're going to kind of distill their wisdom into something that you can actually use in your everyday life.
That's right. Yeah, no one wants to wade through, hundreds of pages of dense financial jargon.
No.
We're going to pull out the good stuff.
Right. We're going to find the good stuff.
The insightful stuff, the counterintuitive stuff,
Yeah,
the stuff that's going to make you a smarter investor.
Absolutely. Okay, so let's start with a really basic question. How are businesses structured?
Okay.
You've got your sole proprietorships.
Yeah.
You got partnerships.
Right.
But we're really focusing on corporations today. Why is that?
Well, corporations have a few key advantages that make them kind of particularly interesting for investors.
Okay.
So one is limited liability. Okay.
So if the company goes bankrupt, you as an investor aren't personally on the hook for its debts.
Got it.
Your risk is limited to the amount that you invested, which, that makes sense.
Right.
It encourages people to invest knowing they're not going to, lose their house or their life savings if things go south.
Exactly.
And then the other big one is perpetual life.
Okay.
A corporation, it's not tied to the lifespan of its founders.
Okay.
Right? It can continue to exist even if the original owners, move on or pass away or retire.
Right. So like a business can live forever.
Theoretically, yeah.
Yeah.
Which is, that's crucial for long-term planning and growth.
Absolutely. Okay. So now we've got that basic structure down.
Yep.
Let's talk money.
My favorite topic.
How do we actually figure out
Yeah.
if a company is financially healthy?
Okay.
I'm guessing accounting statements are pretty important.
Oh, they're essential.
Yeah.
Think of like the balance sheet and income statement as a company's financial dashboard.
But here's where it gets interesting.
Okay.
There are these things called non-cash items.
Non-cash items.
Yeah.
What's a non-cash item?
So these are things that can make a company's cash flow look different from its reported earnings.
Okay.
Like depreciation, for example.
Depreciation.
Uh-huh.
Okay. So depreciation is kind of like when a company buys a big, expensive piece of equipment.
Right.
And it doesn't just take the cost all at once.
Right. Spread out over time.
Right. Like it depreciates over time.
Exactly.
Oh.
But that spread out cost, even though it shows up on the income statement, it isn't an actual outflow of cash in those later years.
Right.
So a company's cash flow might actually look a lot healthier than its income statement suggests.
So it's kind of like you have to be a financial detective almost.
You could say that.
And look between the lines.
Yeah.
Okay, cool. All right, so now let's get to the heart of corporate finance. How companies decide if a project is even worth pursuing.
Right.
Like if it's worth investing in.
Okay.
This is where we get to net present value.
Or NPV.
NPV, yes, exactly. And it's all about this idea called the time value of money.
The time value of money.
Which is just basically this concept that a dollar today is worth more than a dollar tomorrow.
Exactly, because you could invest that dollar today.
Right.
And earn interest on it.
Right. And that dollar tomorrow hasn't earned you any interest yet.
Exactly.
Got it.
So NPV helps companies figure out if the future returns from a project are actually worth more than the money they invest today.
So essentially, are we going to make more money than we spend?
In today's dollars.
Right.
Yeah.
Okay, cool. So, I mean, I'm guessing this is something that companies actually use.
Oh, yeah. This is not just some theoretical concept. This is like real-world decision-making.
Right.
Back in 2000, Quaker Oats purchased Snapple for $1.7 billion.
Sounds like a good deal.
Seems like a pretty sweet deal, right?
Yeah.
But they based their decision on overly optimistic sales projections. The NPV of that deal, when you factor in like more realistic numbers, was likely negative.
Oh, no.
Just 3 years later, they sold Snapple for a measly $300 million.
Wow. What a loss.
Yeah. Talk about a sour ending.
That's a really good, lesson that even these huge companies can make really bad decisions if they don't consider NPV.
Absolutely.
Okay, so NPV helps us avoid those mistakes.
That's the goal. It's a really powerful tool
cool.
for making smart investment decisions.
Okay, that makes a lot of sense. So now, how does this idea of compounding play into all of this?
Okay, so compounding. It's kind of the magic ingredient of investing.
Okay.
It's this idea that interest earned
Good.
can itself earn interest.
Oh.
Right. So it might not seem like much at first, but over time, the difference can be huge.
Okay, so let's say I invest like $1,000.
Okay.
And I earn a modest 5%.
Okay.
Every year.
Yeah.
So the first year, that's $50.
Right. Not life-changing.
No.
But here's the kicker. In year 2,
Yeah.
you're earning 5%
Okay.
on $1,050.
Oh.
Not just the original 1,000.
Got it.
It's like a snowball rolling downhill.
Okay.
It just keeps gathering more and more snow.
I like that analogy.
So the longer you let that money compound, the faster it grows.
That makes a lot of sense.
And this applies to everything from retirement savings to the way companies think about long-term investments.
Absolutely.
Yeah.
Now, there are different ways to calculate interest, right?
There are.
Like, I remember hearing of something called continuous compounding.
Yes.
What is that?
So it's a way of calculating interest
Okay.
as if it were being added constantly,
Okay.
rather than at set intervals like, annually or monthly.
Got it.
So to really illustrate its impact, let's talk about Linda DeFond.
Okay. Tell me.
She invested $1,000
Oh,
at a continuously compounded rate of 10% for a year.
yeah.
She ended up with $11,520.
Right.
So that extra $5.20
Okay.
compared to simple interest showcases the power of continuous compounding.
That's a pretty significant difference for just 1 year.
It is.
So even small changes in the way interest is calculated can have a big impact over time.
Absolutely. Now that we've kind of got a handle on these core concepts, let's move on to how companies actually raise the money.
Yep.
They need to operate and grow.
Okay.
And there are a few key ways they do this.
Okay. Let's hear it.
So one way is by issuing bonds.
Bonds.
They're essentially IOUs
Okay.
from a company or government
Right.
promising to pay back the principal plus interest
Okay.
over a certain period.
So if I buy a bond from a company, I'm essentially loaning them money.
Exactly.
And they're saying, hey, we're going to pay you back this amount of money plus interest.
Yep. And there are different types of bonds.
Okay.
But one of the most common are what are called level coupon bonds.
Level coupon bond.
These pay regular interest payments called coupons.
Coupons?
And then the face value back at maturity.
Okay, so it's like you get a little bonus each year. And then you get the full payout at the end.
Right.
Okay, that makes sense. But what happens to those bonds if interest rates in the market change?
That's a great question.
Yeah.
Bond prices actually move in the opposite direction of interest rates.
Oh, really?
Yeah.
Okay.
So if interest rates rise, new bonds will be issued with higher coupon payments,
Okay.
making existing bonds with lower coupons less attractive.
Got it.
So their prices fall to compensate.
Interesting. So it's like a seesaw.
Exactly.
As one goes up, the other goes down?
You got it. Now, another common way companies raise capital
Okay.
is through stocks,
Stocks. Okay.
which represent ownership in a company.
Okay. So when you buy a stock, you're buying a tiny little piece
You got it.
of that business.
A little slice of the pie.
Right. And you're hoping that piece grows in value over time.
Exactly.
Okay. So how do stockholders actually make money?
Well, there are two main ways.
Okay.
One is through dividends, which are kind of like those regular interest payments from bonds, but they're not guaranteed.
Right.
And then the other way is through capital gains,
Okay.
which are profits from selling shares
Yeah.
at a higher price than you bought them for.
Got it. So there's the potential for big gains with stocks,
Absolutely.
but also a lot more risk compared to bonds.
That's the trade-off.
Right.
Higher risk, higher potential return.
Makes sense. So investing in the stock market really is all about balancing that risk and potential reward.
Exactly. You've got to find that sweet spot.
Okay. So companies can issue bonds or stocks to raise money. What about when they're considering like launching a new product or expanding into a new market?
Right.
How do they evaluate those opportunities?
So that's where this concept of the internal rate of return, or IRR, comes in.
IRR.
It's basically like finding the tipping point
Okay.
where a project becomes financially worthwhile.
Got it.
So if the IRR is higher than the company's required rate of return,
Right.
it's generally a good investment.
Okay. So it's helping them decide
Yeah.
which projects are worth pursuing.
Yeah.
Yeah.
Similar to NPV.
Yeah. In many cases, the IRR rule and the NPV rule will agree.
Okay.
But there are times when IRR can be misleading, especially with like unconventional cash flow patterns.
Okay. Can you give us an example of that?
Sure. Imagine investing in a trendy food truck.
Okay. Food truck.
Right. You make a lot of money up front,
Yeah.
but then you've got these ongoing expenses.
Right, like gas.
For ingredients and gas and maintenance.
Right.
That kind of eat into your profits over time.
Right.
So in these cases, the IRR might give you a false positive.
Okay.
Whereas the NPV would give you a more accurate picture.
So even though IRR can be helpful,
yeah,
NPV is still king when it comes to evaluating projects.
The BV is the gold standard.
Okay, cool.
Okay.
Now, besides making smart investment choices, companies also need to think about managing risk.
Risk management. Huge.
Huge.
How do they go about that?
Right, because there are so many different risks that a company could face.
There are so many.
Yeah.
So one way is through diversification?
It's this idea of spreading your investments across different assets, industries, or geographic regions to reduce the impact of any single investment performing poorly.
So it's like, don't put all your eggs in one basket.
Exactly. That's the idea.
But how can like a small business owner achieve diversification if they don't have the resources of like, a huge corporation like General Electric?
That's a great point. While large companies might diversify across various business segments, a small business owner could diversify within their niche.
Okay.
Maybe they offer a wider variety of products or services.
Got it.
They target different customer demographics.
Right.
Or they expand their online presence.
Makes sense.
To reach a broader market.
So there are still ways, even for small businesses, to kind of spread that risk.
Absolutely. Yeah. It's all about being creative and finding ways to spread your bets.
Got it. Of course, there's more to risk management than just diversification.
Oh, yeah. For sure.
Right.
Companies also need to think about things like operational risks.
Operational risks.
And like supply chain disruptions, cybersecurity breaches, as well as financial risks. Related to like debt levels and interest rates.
So it's kind of a multi-layered approach to thinking about risk.
It is. It's an ongoing process.
Absolutely.
Constantly adapting to this ever-changing business landscape.
Right. Okay. Now let's dive into something that I think can be kind of intimidating for a lot of people.
Okay.
This idea of beta and the capital asset pricing model, or KAPM.
The KAPM sounds very complex.
It can seem that way at first, but it's a really crucial concept in finance.
Okay.
It helps us understand the relationship between risk and return.
Okay.
And you remember beta, that measure of how much a stock's price tends to move?
Right.
In relation to the market?
Right. So a higher beta means the stock is more volatile.
Yeah.
But it also has the potential for higher returns.
Higher reward.
Right. So is that what the KAPM is all about?
Exactly.
Okay.
The KAPM uses beta
to estimate the expected return for an asset based on its risk relative to the market.
So it's kind of like a way to assess whether an investment is worth the gamble.
Yeah, you could say that.
Okay.
But it's important to remember that the KAPM is a model.
Right.
It's a simplification of reality.
Okay.
It relies on some assumptions that don't always hold true in the real world.
Right. It's like assuming everyone in the market is perfectly rational.
Exactly.
And always makes decisions based on, cold, hard logic.
Right. No emotions involved.
Which we know that's not true.
We're all human.
Right.
We're all driven by,
fear, greed,
all sorts of biases.
Right.
And then the other thing is that the KAPM is based on historical data, which might not always be a reliable predictor of future returns.
Right.
So while it's a useful tool, it's not a crystal ball that can predict the future with perfect accuracy.
Got it. So we need to be aware of those limitations.
Absolutely.
But still use it as a helpful framework.
As a framework.
Yeah, okay.
For understanding risk and return.
Got it. Okay. Now, besides issuing bonds and stocks, what are some other ways that companies can raise money?
Well, they can issue something called preferred stock.
Preferred stock. What's that?
It's kind of a hybrid between debt and equity.
Oh, okay.
It typically pays a fixed dividend, but it doesn't have the same voting rights as common stock.
So it's kind of like a middle ground between the two.
Yeah, exactly.
Okay. And then is there anything else?
Another option is a private placement.
Private placement.
Where a company sells securities directly to a small group of investors. Often institutional investors or wealthy individuals.
So instead of going public and offering shares on the stock market, they're kind of keeping it a little bit more exclusive.
Yeah, exactly. Private placements can be faster and less expensive. But those investors don't have the same liquidity. They can't just easily sell their shares on the open market.
Okay, that makes sense. What about leasing?
Leasing.
Yeah. Is that a way for companies to access funding?
Absolutely.
Okay.
Leasing is essentially renting an asset.
Okay.
Like equipment or real estate, instead of buying it outright.
So, like, instead of buying a car, I just subscribe to a car service.
Exactly. And it can be a good option for companies that don't want to tie up a lot of capital in fixed assets.
Makes sense.
Or that need to upgrade equipment frequently.
Right.
But there are different types of leases. You've got operating leases, which are like short-term rentals. And then capital leases, which are more like financing arrangements.
Got it.
Where the company is essentially buying the asset over time.
Makes sense.
Yeah.
And the accounting treatment for those can be very different.
Very different.
Which can affect a company's financial statements.
For sure. Now, speaking of financial statements, we talked about depreciation earlier. It's a non-cash item. But what are some other things that can affect a company's cash flow without actually involving cash coming in or going out? I'm intrigued.
So one example is deferred taxes.
Deferred taxes.
These arise from differences in how companies recognize revenue and expenses for tax purposes versus financial reporting purposes.
So it's like a timing difference.
Exactly.
The taxes will eventually be paid. But not necessarily in that current period.
Exactly. That's why it's so important to look beyond just the income statement. And consider the statement of cash flows.
Got it.
To get a true picture of the company's financial health.
That makes sense. Now let's talk about something that I feel like is always in the headlines. Mergers and acquisitions.
M&A.
M&A. It seems like every week.
It's a busy world.
There's a new company buying another company.
Yeah. It's a very dynamic part of the business world.
So why are all these companies doing all these mergers and acquisitions?
So there are lots of reasons.
You know, they might be pursuing synergies.
Synergies.
Trying to gain market share, access new technologies, or even just eliminate a competitor.
So if you can't beat him, buy them.
Sometimes that's the strategy.
So with all these high-profile deals, how do companies actually go about valuing a potential acquisition target?
That's a great question. It involves a lot of due diligence. Crunching numbers, evaluating the target company's, financial performance, their assets, their market position.
That's it.
But it's not just about cold, hard data. They also need to consider the strategic fit. And future potential of the combined companies.
So it's not just numbers.
It's not just numbers.
There's this subjective element.
Absolutely.
Of will these companies work well together?
Is this going to be a good marriage?
And I'm sure there's a lot of pressure.
Oh, yeah.
And emotion involved in those negotiations.
Big time. You've got pride, ego, the fear of missing out. All of that can cloud judgment and lead companies to overpay for acquisitions.
Like a prime example of this is the AOL Time Warner merger back in 2000.
Oh, yeah.
Which at the time was like the largest corporate merger.
It was huge.
In history.
Yeah, I remember that one.
It was supposed to be like this game changer,
The internet giant merging with the media powerhouse.
Exactly.
But, cultural clashes, integration challenges. The dot-com bubble burst. All of that contributed to the deal being widely considered one of the worst mergers of all time.
Oh, wow.
So even with all that due diligence and financial modeling, things can still go wrong.
It's a risky business.
It is. Mergers and acquisitions are complex transactions with inherent risks.
Now, let's shift gears a little bit. And talk about what happens when things don't go as planned and companies start struggling financially. We enter this world of financial distress.
Financial distress. Not a fun place to be.
No, not a fun place to be. But it's a reality for a lot of companies.
It is.
So when companies face this financial distress, what are their options?
Well, they have a few options. They can restructure their debt. Sell assets. Or, as a last resort, file for bankruptcy.
Bankruptcy?
Yeah.
That sounds pretty drastic.
It is a big step.
Is that basically a death knell for a company?
Not necessarily. It can actually be a way for a company that's drowning in debt to kind of hit the reset button, renegotiate with creditors, and potentially emerge as a healthier business.
So it's not always the end?
Not always.
It can be a new beginning?
It can be a fresh start.
Of
course, it's a painful process. But sometimes it's the best option for survival.
So it's like a last-ditch effort.
You could think of it that way.
To salvage the company.
Yeah.
But bankruptcy is a very complex legal process.
It is. It has very specific rules and procedures.
Okay, cool. So we've covered a lot of ground in this deep dive into corporate finance.
We have.
We've explored how companies make investment decisions, manage risk, raise capital, navigate the complexities of mergers and acquisitions, and even this financial distress.
It's a multifaceted field.
It really is.
Yeah.
And it's fascinating how all these pieces fit together.
It is. It's like a big puzzle.
It is.
And we're just starting to put the pieces together.
Exactly.
Yeah.
And we've just scratched the surface.
We have. There's always more to learn.
Right.
Which is what makes it so fascinating and challenging.
Absolutely.
Yeah.
But hopefully this deep dive has given you a clearer picture of how this world operates.
Exactly.
So now that we kind of understand like the building blocks of corporate finance,
right.
Let's shift our focus to one of the most crucial aspects of a company's financial health. Cash flow management.
Cash flow.
Cash flow.
The lifeblood of any business.
Yeah, we touched on this a little bit earlier.
We did.
But it's worth emphasizing again.
So important.
That cash flow is the lifeblood of any business.
You can't survive without it.
Right.
Yeah.
It's not enough to just generate profits on paper.
No.
Right? Companies need to have a steady stream of cash coming in to pay their bills, invest in growth, and ultimately stay afloat.
Exactly.
So besides just monitoring their bank accounts, what are some key metrics that companies use to assess their cash flow health?
So one important metric is the cash conversion cycle.
Cash conversion cycle.
Which measures how long it takes a company to convert its investments in inventory and other resources into cash from sales.
Got it.
So it's all about speed and efficiency.
Okay.
How quickly they can turn their products or services into cold, hard cash.
Makes sense. So a shorter cash conversion cycle is generally a good sign?
It's a great sign.
Okay.
It means the company is managing its working capital efficiently, which frees up more cash for other important things, like reinvesting in the business or returning value to shareholders.
Okay. Now let's talk about something that no company can escape. Taxes.
Taxes.
I know it's not the most glamorous topic.
Not the most exciting.
No. But how do taxes actually impact corporate financial decisions?
Taxes are a crucial consideration for any company, big or small. They can influence everything. From investment decisions and capital structure to dividend policy and even executive compensation.
So it's not just about paying your fair share. It's about strategically managing...
It's about being smart.
Your tax liability. To maximize financial performance.
Exactly. And there are a number of legal and ethical ways that companies can do this. You know, they can take advantage of tax deductions, credits deferrals. It's like a game of financial chess.
I like that analogy.
Trying to make the most advantageous moves from a tax perspective.
Okay. Now, I imagine tax laws can be pretty complex.
Oh, they are.
And constantly changing.
And constantly evolving.
So companies need to really stay on top of that.
They do. They need to have a solid understanding of the tax code.
Right.
And stay up to date on any new legislation or regulations that might affect their bottom line.
Absolutely.
Yeah.
Now, let's touch on a topic that can be, I think, a bit sensitive.
Okay.
Executive compensation.
Executive compensation.
How are CEOs and other top executives paid?
Okay.
And how does that relate to a company's financial performance?
Oh, that's a great question. Executive compensation is a complex issue.
It is.
Lots of debate surrounding it.
Right.
One key concept, though, is this idea of alignment of incentives.
Alignment of incentives.
So structuring executive pay in a way that motivates them to make decisions that benefit shareholders.
So the idea is if the company does well, the executives also benefit financially.
Exactly. And this is often done through things like stock options.
Stock options.
Which give executives the right to buy company stock at a certain price in the future. So if the stock price goes up, they profit just like shareholders.
Makes sense.
Yeah.
But hasn't there been some criticism that executive pay has become excessive in some cases?
Yeah.
Even when companies aren't performing well.
That's a valid concern. There's been a lot of discussion about whether CEO pay is truly aligned with company performance and whether shareholders have enough say in how executives are compensated.
It's an evolving area.
It is.
With ongoing debate about what constitutes fair and effective compensation.
For sure. It's something investors should definitely be aware. Absolutely. And it's something investors should definitely be aware of and consider,
Right.
when they're evaluating a company.
Right.
It's corporate governance practices.
Okay. So we've talked about, these different ways that companies can raise money through bonds, stocks, preferred stock, private placements.
Right.
Now let's go back to those financial statements for a moment.
Okay.
We talked about depreciation earlier as kind of a non-cash item.
Uh-huh.
But what are some other things that can affect a company's cash flow?
Right.
Without actually involving cash coming in or going out?
Yeah. So one example is deferred taxes.
Deferred taxes.
Okay.
Okay, so what are those?
So these arise from differences in how companies recognize revenue and expenses for tax purposes versus financial reporting purposes.
Right.
So it's like a timing difference. Right. The taxes will eventually be paid.
Right.
But not necessarily in that current period.
So it's kind of like kicking the can down the road a little bit?
You could say that.
But eventually you got to pay the piper.
You do.
Okay. That's why it's so important to look beyond just the income statement.
Yes.
And consider the statement of cash flows.
The statement of cash flows, very important.
To really get that true picture.
Yeah, the whole picture.
Of the company's financial health.
Exactly.
Okay. Now let's talk about something that I feel like is always in the headlines.
Yeah.
Mergers and acquisitions.
M&A.
M&A. It seems like every week
it's a busy world out there.
There's news about some company buying another company.
It's a very dynamic part of the business world.
So why are companies doing all of these mergers and acquisitions?
There are lots of reasons.
Okay.
Companies might be pursuing synergies.
Synergies.
Trying to gain market share.
Okay.
Access new technologies. Right. Or sometimes even just eliminate a competitor.
So if you can't beat them, buy them.
Sometimes that's the strategy.
Sometimes.
Okay.
So with all these high-profile deals, how do companies actually go about valuing a potential acquisition target?
So that's a great question. It involves a lot of due diligence.
Due diligence.
Crunching numbers.
Okay.
Evaluating the target company's financial performance.
Right.
Their assets. Their market position.
Makes sense.
But it's not just about cold, hard data. They also need to consider the strategic fit.
Okay.
And future potential of the combined companies.
So it's not just numbers.
It's not just numbers.
There's this kind of subjective element to it.
There is a subjective element.
Will these companies work well together?
Is it a good marriage?
Is this a good marriage? And I imagine there's a lot of pressure and emotion involved in those negotiations.
A lot of pressure, a lot of ego,
right?
Fear of missing out.
Yeah.
All of that can really cloud judgment,
right?
And lead to companies overpaying for acquisitions.
Right. Like a prime example of this is that AOL Time Warner merger back in 2000.
Oh, yeah.
Which at the time was like the largest corporate merger
huge
in history.
I remember that one.
It was supposed to be this game changer, right?
It was supposed to be revolutionary.
This internet giant.
Merging with the media powerhouse.
Right.
But, cultural clashes.
Okay.
Integration challenges.
Right.
The dot-com bubble burst.
Yeah.
All of that contributed to that deal.
Yeah.
Being widely considered one of the worst mergers of all time.
So even with all that due diligence and financial modeling, things can still go wrong.
They can. It's risky business.
It is. Mergers and acquisitions are complex.
They are.
With a lot of inherent risks.
Absolutely.
Okay. Now let's shift gears a little bit and talk about what happens when things don't go as planned.
Oh.
And companies start struggling financially.
Okay.
We enter this world of financial distress.
Financial distress.
Yeah.
Not a fun place to be.
No, not a fun place to be. But it's a reality for a lot of companies.
It is, unfortunately.
So when companies face this financial distress, what are their options?
So they have a few options. They can try to restructure their debt.
Yeah.
They can sell assets.
Right.
Or as a last resort, they can file for bankruptcy.
Bankruptcy.
Yeah.
That sounds pretty drastic.
It's a big step.
Is that like a death knell for a company?
Not necessarily.
Okay.
It can actually be a way for a company that's drowning in debt to kind of hit the reset button.
Right.
Renegotiate with creditors.
Got it.
And potentially emerge as a healthier business.
So it's not always the end?
Not always. It can be a new beginning.
Okay.
Of course, it's a painful process.
Right.
But sometimes it's the best option for survival.
Right. So it's kind of like a last-ditch effort.
You could think of it that way.
To salvage the company.
Yeah, to try to save what you can.
Okay. Now, bankruptcy is a very complex legal process.
It is. It has very specific rules and procedures.
Right. It's not something to be entered into lightly.
Definitely not.
Right. It's not something to be entered into lightly.
Definitely not. But it's a tool that's available.
Right.
if needed.
Okay, cool. So we've covered a lot of ground in this deep dive into corporate finance.
We have.
We've explored how companies make investment decisions, manage risk, raise capital, navigate the complexities of mergers and acquisitions, and even this financial distress.
It's a multifaceted field.
It really is.
Yeah.
And it's fascinating how all these pieces kind of fit together.
It is. It's a big puzzle. We're just starting to put the pieces together.
Absolutely. But hopefully this deep dive has given you a clearer picture of how this world operates.
Absolutely. I think it highlights just how important it is for investors to really understand these concepts.
You do your research.
Yeah, to do your homework.
Right.
To look beyond just the headlines.
Right.
And really dig into a company's financials.
Absolutely. Because there's so much more than meets the eye.
There is. There's a whole story behind those numbers.
Exactly. And I think that's what we've really uncovered today.
I think so too.
Is that there's this whole story behind those numbers.
Yeah. And it's a fascinating story.
It is. And it's a story that everyone should understand.
Absolutely. Because whether you're a seasoned investor or just starting out, these concepts are essential.
For making smart financial decisions.
For navigating the world of finance.
Absolutely. Well, this has been a fantastic deep dive.
It has.
Into the world of corporate finance.
Yeah. I feel like we've covered a lot of ground.
We have.
Yeah.
We've gone from the very basics to some pretty complex topics.
We have. But hopefully in a way that's been, engaging and easy to understand.
Absolutely. And I think most importantly, it's given our listeners some really valuable insights.
Yes.
That they can take away and use.
To make better decisions.
In their own financial lives.
Absolutely.
So thank you so much for joining us.
It's been a pleasure.
On this financial adventure.
Oh, my pleasure.
And to our listeners.
Yes.
We hope you found it insightful and engaging.
And we hope you learned something.
Absolutely.
Until next time, happy investing.
Happy